what is Commodity Channel Index (CCI). And by the end of this session, you should be able to understand what is Commodity Channel Index indicator, how to interpret and use the indicator. The Commodity Channel Index, or also known as CCI, is a popular trading indicator used to determine the strength of a market's momentum. This indicator is developed by Donald Lambert to analyze the commodity market, but it is now widely used by traders to trade on multiple assets. When the CCI indicator rises above plus 100 level, the market is overbought. And when the CCI indicator falls below the negative 100 level, the market is oversold. The CCI indicator oscillates between fixed level of plus 100 and negative 100, or plus 200 and negative 200. Let's look at the formula based on 21 period CCI. The CCI indicator uses the typical price and measures it against the 21 period simple moving average value. The result is then divided by the constant 0.015 so that the CCI falls within plus 100 and negative 100 most of the time. And the mean deviation shows how far price has deviated from its mean price. We'll go through the CCI indicator trading techniques in detail on chart and also how to use it with combination of price action. Let's begin with placing the CCI indicator on chart. To place the CCI indicator on chart, there's few methods to do it. The first method is go to Insert, then Indicators. Under the Oscillators, select the Commodity Channel Index. The second method will be the easiest one, as you click and drop it from the Navigator panel. To do that, simply go to Navigator panel, Indicators. Under the Oscillators, click the Commodity Channel Index, drag and drop it on chart. It's done. Now let's look how to use the Commodity Channel Index in trading. There are three methods in which traders can use the CCI indicator during trading. They are identifying the extremes in CCI by going long when the market is oversold and going short when the market is overbought. Identifying the divergence between the CCI indicator and the market. And finally, using the CCI indicator in combination with moving average. Let's look one by one in details how to use them. Overbought and oversold. The most common CCI trading strategy is to look for overbought and oversold extremes. This means that traders buy when the CCI indicator falls below negative 100 oversold and sell when the CCI indicator rises above plus 100 overbought. The logic behind this strategy is that when the market rallies too much, it's more likely to make a pullback. On the other hand, if the market falls too much, it's more likely to make a bounce. Based on my experience, this method can be used only when the market is in sideways, but not during trending. Just because the market has rallied too much and is overbought, it doesn't mean that the market must drop. And when the market has fallen too much and is oversold, it doesn't mean that the market must rise. Let's look at this example. Market continuing to rally despite the CCI indicator suggesting that the market is overbought. Bullish and bearish divergence. Divergence is considered one of the strongest signals of any oscillator. Divergence is formed much less frequently than just entries into overbought and oversold zones. Therefore, they are more reliable as a signal. Mostly, traders use divergence to predict tops and bottoms in the market by connecting two or more lows or highs on the price chart and CCI indicator with straight lines. If the line on the chart is directed towards the trend, and the line on the indicator is already pointing in the opposite direction, there is highly probability that the trend will change. A bearish divergence happens when the market making higher highs, but the CCI indicator does not make higher highs. This indicates that the market is overextended. The rising power is minimal and signals the market may fall soon. Bullish divergence. A bullish divergence happens when the market making lower lows, but the CCI indicator does not make lower lows. This indicates that the market is oversold. The decline may be slowing down and signals the market may rise soon. Here are a few examples of CCI divergence signals. Combination. Based on my experience as a professional trader, the best way to use the CCI indicator is to gather with moving average to define the market trend and execute the buy or sell trades. This will give a high chance of winning rate. So how do we define the market's trend? There are many ways, but one of the easiest and most common ways is to simply look at the market's 200-day moving average. This means that traders should go long when the market is above the 200 moving average and has made a short-term pullback and the CCI indicator is below -100 level. And similarly, traders should go short when the market is below the 200 moving average and has made a short-term bounce and the CCI indicator is above +100 level. Here are few examples of CCI combination signals.